This descending trend line maps exactly what is happening to altcoin liquidity right now. Here in April 2026, the heavily promoted supercycle is stalling. Bitcoin is struggling to maintain the $70,000 threshold, and the rest of the market is rapidly bleeding out. Retail investors are caught in a massive trap. You have to ask yourself if you are holding through a routine, healthy correction, or if you are staring at the first wave of a multi-year crash. Historically, cryptocurrency operated entirely in a vacuum. If Bitcoin went up, the entire market followed. You bought in, held on, and waited for the inevitable bull run to lift every token in your portfolio. Institutional approval through spot ETFs integrated crypto into the traditional financial system as a regulated balance sheet asset. Major financial houses now treat digital tokens as standard entries on their quarterly reports. By integrating into traditional finance, cryptocurrency now breathes the exact same air as the S&P 500 and the Nasdaq. It reacts instantly to macroeconomic forces, meaning the old rules of crypto investing are permanently broken. The first major force driving this shift is the Federal Reserve. Inflation has proven incredibly sticky, locking the economy into a higher-for-longer interest rate trap. Predictive markets show an 89% probability that rates stay exactly where they are. Wall Street had confidently priced 3 rate cuts into their models for this year. With those cuts erased from the calendar, the market is violently repricing. In institutional finance, repricing is the polite term for a massive sell-off. The U.S. Treasury is actively issuing record amounts of debt with a guaranteed return of 4 to 5%. When you can get a guaranteed risk-free yield from the government, high-risk assets like Bitcoin face immense pressure to justify their volatility to big investors. This creates a highly toxic environment for everyday retail traders. Millions of people borrowed heavily, using leverage to bet on an aggressive 2025 supercycle that never materialized. This step chart illustrates the slow-motion liquidation process. As borrowing costs escalate, the price of holding on to leveraged debt becomes unsustainable. Instead of experiencing a single, sudden 20% crash, retail portfolios are bleeding out 1% at a time every single day. As long as the Fed keeps the cost of capital elevated, this slow, methodical extraction of retail wealth will continue. To understand the market's lack of momentum, you have to look at liquidity. Liquidity is the essential fuel required for any financial asset to move upward. Cryptocurrency is now competing against a massive new sector for that exact same fuel. The artificial intelligence industry, driven by megacaps like Microsoft and NVIDIA, is absorbing capital at a historic rate. During the last cycle, institutions bought speculative altcoins to secure massive multipliers. Today, they look at meme coins with zero utility, compare them to the record-shattering real-world cash flows generated by AI giants, and allocate their capital accordingly. This flowchart demonstrates the vampire effect. Institutional capital is bypassing crypto to fund AI giants reporting billions in free cash flow. With capital flowing outward, Bitcoin's market dominance has pushed near 58%, and the altcoin season index has collapsed to a dismal 35. Crypto is losing the war for capital. For anyone holding speculative tokens, the crash is already here. Curious, observant. While retail sentiment fluctuates on social media, institutional investors are focused on rotating capital between specific sectors. They are repositioning their holdings, rather than exiting the market entirely. The passage of the Clarity Act guidelines created a permanent regulatory shift. It gave Wall Street the precise legal framework they needed to engage with digital assets safely. Major U.S. banks view Bitcoin through the lens of a strategic reserve. They treat it as a legitimate treasury asset, buying the dips to build a massive geopolitical hedge against a $34 trillion national debt. Beyond Bitcoin, institutions are executing a ruthless flight to quality. They are actively abandoning highly valued ghost chains that lack active users or real-world adoption. This network map shows exactly where that capital is moving. Funds are bleeding out of peripheral projects and funneling straight into Ethereum. Whales are aggressively accumulating ETH below $3,000 to front-run the massive infrastructure improvements coming with the Glamsterdam upgrade. Wall Street is stripping away the dead weight. They are consolidating their capital strictly into assets with permanent technological utility. The current market data suggests we have moved into a selective environment where speculative assets no longer follow Bitcoin's lead. The asset class is firmly split in two. Bitcoin will maintain its role as a digital gold hedge, supported by heavy institutional adoption and global debt concerns. But the altcoin casino is facing a severe reckoning. If a token project does not have verifiable real-world utility or major institutional backing in 2026, it is a liability, and its price will continue to bleed. To survive this environment, you have to stop chasing social media hype. You need to monitor the Federal Reserve, because their interest rate decisions dictate the direction of your portfolio more than any technical chart pattern. Smart money is building strategic positions designed to mature in the 2030s, not next Friday. It is time to align your strategy with the institutions holding the capital. What is your move in this new market? Are you buying the dip on infrastructure or waiting for a deeper correction? Let us know in the comments below.